Today on the show, we're diving into the world of economic indicators. These are the numbers that tell us how the economy is doing, things like GDP, unemployment rates, and consumer confidence. But what do these indicators really mean? How are they calculated? And how should we interpret them? We'll break it all down for you, with the help of some experts, to make sense of the numbers that shape our world. 1. What do economic indicators really mean? Economic indicators are statistics that provide insights into the health and direction of an economy. They help policymakers, investors, and businesses make informed decisions. There are three main types. Leading indicators predict future trends, for example, stock market performance, new business startups. Lagging indicators confirm trends after they happen, for example, unemployment rate, corporate profits. Coincident indicators reflect current economic activity, for example, GDP, retail sales too. How are they calculated? Each indicator is measured differently. GDP, gross domestic product, the total value of goods and services produced in a country, calculated using expenditure C plus I plus G plus an X, income, or production approaches. Unemployment rate, the percentage of the labor force that is jobless and actively seeking work measured via household surveys. Consumer Confidence Index CCI, surveys consumers about their financial outlook and spending intentions. Inflation CPI and PPI, tracks price changes in consumer goods CPI, and producer inputs PPI over time. 3. How should we interpret them? Context matters. A single indicator doesn't tell the whole story. For example, low unemployment is good, but if wages aren't rising, it may not reflect true economic health. Trends over time. 1 month's data can be volatile. Analysts look at long-term trends, for example, GDP growth over quarters. Comparisons, economists compare indicators across regions or against forecasts to gauge performance. Expert insight. Economic indicators are like a dashboard for the economy. They tell you if you're speeding up, slowing down, or are heading toward trouble. But just like driving, you need to watch multiple gauges at once. 1. Dashboard of key economic indicators. Visual concept. A car dashboard with gauges representing different indicators. Speedometer gives GDP growth, showing acceleration or slowdown. Fuel gauge gives unemployment rate, low equals healthy. High equals warning. Temperature gauge gives inflation, CPI overheating equals high inflation. Warning light gives consumer confidence, red equals low optimism. To a GDP explained infographic. Visual concept. A pie chart or flowchart breaking down GDP components. See consumption. Shopping cart icon. 70% of US GDP. Investment, factory, building under construction, unmet spending, school, hospital icon. NX net exports. Cargo ship with plus a balance. 3. Unemployment rate timeline. Visual concept. A line graph showing x-axis, years, for example, 2020 to 2024. Y-axis, unemployment percent. Notable spikes. COVID-19 2020. Recession shaded in red. 4. Inflation, CPI visualized. Visual concept. A shopping basket with price tags inflating like balloons. 2019. Milk equals $3.50 2024. Milk equals $4.50. Balloon size represents price increase over time. 5. Leading versus lagging indicators. Visual concept. A racetrack with leading front runners, stock market arrows, building permits lagging behind, unemployment line, corporate profits.